Meantime, Wells Fargo is revamping its investment strategy for 2019. Strategists from the bank are now recommending investors rotate out of growth stocks and into value stocks. Joining us now to talk more about it, Cantor's chief market strategist, Peter Cecchini. Peter, do you agree with that strategy?
Well, I think it makes sense at this point in the cycle. I think historically, towards the end of the cycle, you have to rotate certainly out of momentum and growth and into value. And there are a lot of different reasons for that, but when investor mentality shifts from risk on to risk off, which I think is afoot now, value does tend to outperform. That said, if we are in the part of the cycle I think we're in, then both value, momentum, and growth will likely not do well into the end of this year.
We had Julia on yesterday. We were talking about Dan Loeb, Third Point, exiting some key positions, and it seemed like there was a mass exodus of tech stocks.
Yeah.
So while that happens to be a little bit of a lagging indicator, does it say something about how big investors are looking at this market right now?
Well, I obviously can't comment on any individual investor's positions, but what I would say is yes. We even noticed this early in the year. Fangs, for example, actually started to underperform before the broader market did. We pointed that out in our work, and that was part of the dispersion that characterized the markets early in the year. We've moved from that dispersion to correlation, meaning the tech stocks tended to sell off first, and then the rest of the market followed. Now everything is rallying together, and the Fangs in particular, we've obviously seen them come back very strongly. My rationale behind why that's happening really has a lot to do more with the communications we're getting from central banks and where we are in the cycle than anything else.
Okay, so let's touch on that point for a moment. Where are we in the cycle, and how do you think the Fed is going to react?
Well, it's interesting because I think a good bit of the sell-off below 2,500 in the S&P 500 at the end of the year was due to what I've characterized as a miscommunication from Chairman Powell at that December press conference, where he said the balance sheet taper was on autopilot and that they were quite happy to continue on autopilot. What investors, I think, really wanted to hear was, hey, the Fed put's still here if, in fact, at some point the data says we need it. That was not the takeaway from that meeting. And since then, when we put out our outlook for 2019, we said very clearly, look, Fed is likely to pivot, at least in communication, and the markets are likely to rally between 27 and 2,800 on the S&P 500. Now, it's largely happened on sort of more dovish Fed communication. I think the prospects for a trade deal, and the fact that about 2,400, I think the perception was that valuation made a heck of a lot more sense for large cap stocks. Unfortunately, our view is that as we make our way through the year, the financial conditions and the tightening that has already occurred from the Fed hiking rates are going to start to bleed into the real economy.
Yeah.
They've already started to affect the rest of the world, and that's going to come back to affect the U.S.
Okay, so let's sort of take that full cycle and say if global growth slows, then fill in the blank.
Global growth is slowing.
Yeah.
And I think we see this certainly in Europe, and we can touch on China if we have time. That's a long conversation, obviously. But in Europe, we saw first Italy start to roll over, and towards the end of last year, we started talking a little bit more about Italy, but now we have France in contraction when you look at PMIs, Germany in contraction. The UK obviously has its issues with Brexit that are somewhat idiosyncratic, but I think it's really tough to make a growth story for Europe in 2019, which probably means it's tough to make a growth story globally for 2019, despite the fact that the U.S. has clearly outperformed the rest of the world.
And you mentioned it would be a longer discussion on China, but let's try to do it as quickly as we can. Obviously, it's the slowest growth that country has seen in a staggering amount of time. And that's problematic because investors were looking to China over the last decade or even 20 years where the bulk of the growth was supposed to come.
I think that's right, and that's actually one of the drivers for the European growth slowdown. There are others, but that is an important one. And I think for China, you have to look at the circumstantial evidence because obviously the official data isn't necessarily, it's over-curated, maybe we should put it that way. But when we look at what they've been doing to the RRR, for example, the reserve ratio requirement, or the reserve requirement ratio, I always get that backwards, it's been cut from 22% to 13.5% as of the end of January. And they've been doing that to manage the slowdown. The problem is, well, that was a great lever before to release liquidity into the economy. It's not as good a lever now because default rates in China are beginning to rise. And so when you look at that, what is effectively QE through the cutting of that reserve ratio requirement, it's not working.
Yeah.
The money supply is no longer growing, growth is slowing. And that, I think, is going to be China's challenge as it tries to transition from an export economy to a consumption economy to prevent a real slowdown in growth.
It's interesting because yesterday, Zor Capital Managing Director Joe Fahmy, he appeared on Yahoo Finance to explain his current stance on Fang stocks. Listen to this.
So after a big move for the past 5 or 10 years, I'm not saying they're going out of business. I'm not saying to sell them. I'm not saying to short them. I'm just saying investors have to be open-minded, that they need time to correct, digest, and consolidate their gains.
Sounds like good advice.
I think that makes sense.
Yeah.
I also think the FANG stocks tend to be story stocks. And again, I come back to, when it comes to the FANG stocks, I come back to sentiment and how important sentiment is to momentum and growth stocks. When investors are looking for safety, they look at value because they feel like they have a zone of safety, if you will, in valuation, whereas obviously with momentum and growth, you don't always have that.
Right.
So I think that's another reason to be careful of the FANGs here, especially given our broader market view for a pullback into the end of the year.
A little caution is always a good thing. Peter, great to see you. Thank you so much.
Thank you for having me.